Good morning and welcome to today's Incisive Media webcast discussion on conduct risk. Regulator after regulator has been surprised and alarmed that operational risk has now superseded credit risk and market risk as a threat to the stability of individual banks and other financial institutions and the stability of the financial system as a whole. And the key component of operational risk that's been causing all this concern is conduct risk. In the UK, of course, we now have a new Financial Conduct Authority. But there's still a lot of uncertainty surrounding how conduct risk should be managed, how it should be measured, and even how it should be defined. We'll be trying to take a new look at some of these problems here today. Joining me for the discussion are Payman Mestian, a managing partner with Chartis Research, Neil Dodgson, Global Head of the Customer Solutions Group at IBM Risk Analytics, and Vinita Ramtree, Head of Conduct Risk Wealth at Barclays Wealth and Investment Management. Thank you all for joining me. So, probably the best place to start is the definition. I mean, how close are we to a single, generally agreed definition of what conduct risk is and isn't? I mean, there's some uncertainty surrounding even whether it should be rolled into op risk at all. Payman, do you want to start on this subject?
Right. Yeah. So the research that we've undertaken around conduct risk in collaboration with IBM, we surveyed and interviewed well over 100 financial institutions and non-financial institutions, and I think the key finding out of that research was that there is no consistency of definition. I mean, clearly the FCA in the UK has put out a definition out there, but if you look at the problem at a global level, and it is a global problem, then there's no consistency. There's some definitions tend towards focus on conduct relating to consumers, so fair lending, mis-selling of products, and so on, which is I think where it all started from. But increasingly, it's moving beyond just the customer. It's moving into all stakeholders. So market abuse is integrity of the market. Is at a macroeconomic level, and also conduct with your employees, internal conduct around discrimination and so on. So I think the definition started with a focus on fair and equitable behavior towards customers, but it's now expanding.
Particularly retail customers. I mean,
it started with that. It started with that, but now it's around. You're getting the lines are blurring. So sanctions, KYC suitability around not just retail customers, but trading. Capital markets. And if you look at the fines that have been going around, it's to do with codes of conduct, actually, which have been around for a long time. Mm-hmm. But the exact definitions from institution to institution, when we've really drilled down into how they're defining it, it's a bit of a moving target.
Well, from what we've seen and our experience is that it's very much line of business dependent in terms of how they define conduct risk, because people would have gone traditionally and thought about conduct risk, maybe road trading, bearings collapse in 1995, 20 years ago now? Yeah. Gosh. And that obviously gets the headlines, the news, etc. But if you look back, and I can remember the 80s with the unit trust scandal, a lot of people were retiring early in their pensions from large corporates when the pension rules changed. And then there was the unit trust scandal. Then we went into the pension scandal. So it has been inherent in the retail side significantly before we saw the road trading incidents in the 90s. So, and also as well, let's look at recent news. It's not just in the financial services sector; it's also across industry. And I think the big impact from what I look at is Volkswagen cars. I mean, it's all the same. It's behaviour. We don't know why they did that or what the implications are, but it all goes across in the financial services sector where the focus is. But now it's going really across industry as well. But I'm interested to hear what you say from a practitioner's point of view.
Yeah, I think I fully agree with all your views. So definitely, in terms of the definition in itself, there has been moving focus depending on where you come from. So it could have started with focus on customers, moving on to focus on markets, including employees. Of course, with the US base, there's a lot of focus on lending. So, payday lending or, other kind of lending practices are obviously stemming from, the subprime lending issues.
Going further back, I suppose you can point to things like the CRA and the discrimination in lending, which was such a huge problem
Absolutely.
in the 60s and 70s there.
Absolutely. So there's a lot of difference in terms of, who chooses to focus on. But also the other differences that I'm seeing is just the fact that the definitions are quite broad. So that's where people aren't able to really articulate where the start and the stop point is. So, going to your point, one, yes, it's beyond the financial sector. Yes, Volkswagen. And then I read another one this morning is about, Google or, other kind of, internet search engines probably pushing their products in comparison to other products. Could be another issue where they're looking to see, well, how to regulate that. Because as a seller, I'm counting on that search engine to push my product. But, so it will go much broader than financial institutions. But besides that, in the definition also is the difficulty of nailing whether this is direct, culpable, intended poor conduct versus, a consequence of an operational risk, which is where, you started with saying, well, is conduct a part of operational risk, saying, well, yes, something went horribly wrong in the operations and therefore, clients were put at a detriment, or actually I intended to, sell something that probably wasn't suitable for you because that's how I wanted to do it.
Yes, I mean, that's a good point. So the extreme of conduct risk and conduct risk events where you have a Volkswagen type scenario where there is an obvious conscious decision to break the law, to mistreat your customers, or to deceive, is one thing. But conduct risk, as it's now being understood, extends into a whole lot of other areas where there's less of a sort of a bright line definition. There's less obvious conscious decision to mislead or deceive, and you're really getting into more. It's really more of a case of undesirable ways of doing business rather than actual. This individual has committed a crime. This individual has actually done something morally wrong.
I think that's a good point. I think you could isolate. You could look at that. If it's let's use the word systemic within the organisation, that probably is a more, a critical definition of conduct risk. You've got a Nick Leeson acting on his own. I mean, okay, there was failures in the processes and the controls and the checks around it. But if you have got that, let's say PPI, for example, if you have a real block of, it's not criminal, but not treating the customer fairly and misleading the customer, I think that really starts to define conduct risk and the behaviour as well a bit tighter.
Well, I'm not sure you can ever really point to a situation where it's been just one bad apple. I would suspect that in every case where there's been one rogue trader, there will have been a lot of other people who were aware that something was going on, but who didn't want to investigate too thoroughly. They didn't want to take. It's the old joke about Uncle George thinks he's a chicken. You should take him to the doctor. No, yes, but we need the eggs. It's
true.
If I investigate how this guy's making his money, am I going to find something that I will have to report? There's always. But I take your point about this systemic idea, and these can be as damaging, if not more so, to the individual institution, to the system as a whole. But it's much more difficult to look at it through the lens of individual culpability, I suppose. You're talking much more about, well, what were the incentive structures here?
Wow, yeah,
what were the leadership? What were the expectations of leadership? What was the underlying culture? How were people rewarded? How were people encouraged to behave? And you're into an area there where it's much more difficult to address it using traditional criminal sanctions, I suppose. And in some cases, you're into an area where it's much more difficult to address it even using conventional monetary rewards. I mean, a lot of the PPI scandal has been ascribed to people having very short-term objectives in terms of purely in terms of sales and no other considerations. But monetary incentives aren't the only thing that affect the way we behave.
No, true, actually.
You're into a whole area where there's the lines are much more blurred, and it's much more difficult for the regulators to lay down strict guidelines. But actually, and this bring it back to the point I wanted to ask you, Vinita, how useful have regulatory definitions been in this case? I mean, are they easy to translate into this is how we operate inside the company?
I think they're they're easy to give you the overall framework within which you can say, well, you're within, the regulatory requirements, or you're aligned to the regulatory thinking. But you do need to do that additional bit of work, because when you do recognize that there are differences, whether the regulatory definition would be for anyone, whether it's wealth or retail, they're quite standard or generic in some sense, and then you need to be able to translate that into what it actually means. One, for your organization, the culture that you've got in the organization. Two, for your customers. So as you said, depending on what products and services I provide, how does it actually translate to what I'm doing? Am I doing, am I giving advice? Am I, doing execution only? So it depends on how do you then, interpret that definition into what you actually do on a day-to-day level. And also just, where are you today versus where is that definition wanting you to be, and how much that gap is. And based on that, you then have to have your targeted solution. So yes, the definition is great to have, but it's just a starting point. And after that, there's a lot more to be done. For example, there was the vulnerability guidance. So because, vulnerable clients, of course, it's a quite important topic when we talk about conduct, because we've got to bear in mind client vulnerability. But the guidance, I think, was about like 130, 140 pages. And when you take that away and you try and make sense of it and, understand how does that relate to your organization, there is a lot of work to be done. It's just, so it's a good start point, I would say.
Mm-hmm. But and I welcome your opinion, but from what I see, conduct risk for the regulator is primarily to protect the retail or the customer or the investment or the investor on that side. That they're not coming from the culture within the organisation so much. They want the individual consumer at the end of the day to be protected. That's where they're fundamentally coming from.
I fully agree, but how is that going to happen? So
well, no, absolutely.
If you work it back, saying, I'm running a shop, I want to make sure that my customer comes in and takes away a sandwich which doesn't make him ill, after he's taken it away. But what does it mean? Is I'm checking the food safety standards of what I'm actually receiving. So I need to work from the other end of the store to make sure what I'm transacting is fit for use.
So this is where, when we did the research, I really think there's some good lessons to be learned by the financial services industry from non-financial industry. We saw in our interviews and research, we saw some very interesting approaches around zero tolerance before you allow a product to get to market. You test it, and and the testing means different things in different industries, but you basically test it, whether it's testing through stress testing or scenario analysis, or price sensitivities and so on. But if you take the pharmaceutical industry, what they have to go through in terms of drug safety before a product is released, the rigor, the process control, and the lines of validation, product validation and authorization that it has to go through. I think there's some, when we think about mis-selling of insurance or mis-selling of, fixed income or equities products or whatever, I'm not convinced that level of rigor has been applied in financial services industry. And we're paying for it now.
Well, the main difference, you mentioned the pharmaceuticals, the main difference is that the testing process is small scale. You're doing your phase 1 tests on 30 healthy volunteers, and you're doing phase 2 on 60 patients with the disease you're attempting to treat, and so on.
So 10 years of testing for some of the products.
Yeah, I know.
Whereas some of the financial products that have been released in the last 10 years is a couple of people, quants, working on a spreadsheet with a physics degree, and who've never worked in financial services before. So actually,
exactly. It's equivalent to taking the drug from the test tube stage and putting it straight out into the hospitals.
So no, I think there's some lessons to be learned, but in terms of best practices that emerged out of the research, it's not rocket science. I mean, the definition side is interesting, but ultimately, this is a principles-based regulation. So the regulators are providing certain principles, and I don't think we should get fixated on regulation. We should get fixated on the codes of conduct. Bad behavior, you know it when you see it. Yeah.
Agreed.
You know it when you say it. And so I think it's up to the leadership of the institutions to define desirable and undesirable behavior. And conduct risk, to me, is the gap between your definition of desired behavior and any gap between that and the actual behavior. And if that gap is too big, then you're not managing the risk. And it's the classic looking at people, process, and technology, to solve it. Those are the causations.
I think I agree with you. Absolutely, it's probably not good to get fixated on the definition. That absolutely agreed. The second part, yes, it's about the leadership. The key thing here is probably it is about that gap between your desirable behavior and your actual behavior, but also sometimes it is about the perceived gap. Because sometimes when a lot of individuals are doing things right, they aren't used to the level of scrutiny that they're being put through now. So while they might be acting in the best interest of the clients, they might not be able to tell the story and they might not be able to evidence it accurately or adequately. So that was, I think, one of the JP Morgan fines for 3.1 million at some point last year, I believe, where the problem wasn't the fact that clients had been sold anything unsuitable, but it was just about being unable to prove
The audit trail.
Audit trail. Yeah. So it is about the leader accepting both parts, saying, yes, I think there's a gap, and here's how we address the gap. But the other thing is, I might not be able to evidence that we are in line, and here's how I need to, here's what I need to be doing differently to have that story.
I think that's right, and certainly some of the interviews we did was that there was significant investment. Those who are really taking conduct risk seriously, they're putting serious investment around record keeping, workflow, and all the data management and dashboarding and KRIs and KPIs that go around that. So those are the enablers. This research was called the risk-enabled enterprise. So I think the concepts are great, but reality is just putting the enablers in place to inform people. Exactly. Because the reality about it, I think if most undesired behaviors, I think, are unintentional, is some sort of process issue or awareness or training or competence issue, and I think it's the responsibility of the firms to empower them using the right management information, Absolutely. The right training and development.
Because even if they're non-intentional, I say that's still a cultural aspect. There's still it's still down to the individual, the organisation's ethos of how much care do you take, how safety focused, how customer benefit focused are you, as opposed to how keen are you just to get the products out there as quickly as possible, get them sold, and make the commissions.
I think at that point, maybe I just add is where you say it's unintentional versus intentional, and then the lack of being able to demonstrate that evidence goes back to the previous point where we spoke about culpability. Because in the absence of evidence, it gets very difficult to say who's speaking the truth, because then it's a case of both people saying, well, it wasn't intentional, I didn't do it, I made that decision, but I didn't really know, it's going to drive detriment. While one might have fully known and understood, the other might be genuine. So that's where the evidence comes into play, because otherwise it becomes too broad and leaves it to judgment.
But do you think it's stacked in a favour on one particular side now against the bank or the financial institution? And let's look at the...
I think with the senior managers regime, it will be stacked in the favour of the regulation as opposed to the organisation if the burden of proof is going to be reversed. And again, the same as per the study, it says in the US as well, the burden of proof sits with the organisation more. It is possibly going to stack the other way more. The
one I look at, which is the interest rate swaps with the small companies. And, we I don't know anyone who, you probably haven't got mortgages, but I have. I make a decision about a fixed rate mortgage. That's a fixed rate leg of an interest rate swap. And then I see CFOs saying they didn't know what they were doing when they went into the swaps market. Well, if I was the organisation, I would, or the CEO, I'd be a bit concerned that my CFO didn't know what an interest rate swap was on that side. But it seems that the industry was coming back and saying, if you think you've been missold, just go after the institution that sold it to you.
Agree.
I think you're absolutely right. I think focusing on the kind of intentional versus unintentional one is a bit of a red herring.
Yeah.
I mean, take a common activity, take driving. If you've got a kid in the back of the car, you'll drive more carefully. Does that mean when you haven't got a kid in the back of your car, you are intentionally taking risks? And of course it doesn't. You ask someone, they're driving alone, yes, I'm trying to drive safely. But there are the incentive pattern has changed. So without intending to drive more dangerously, I think most people would agree you probably are less safe when you're not taking that little extra bit of care. But I don't think that means you can talk about people intentionally taking risks, intentionally risking crashes. Of course they're not.
No, absolutely.
It's just it's simply a case of how the incentives, how your different considerations add up. Let's talk about the management side in more detail. I mean, without getting sidetracked by the definitions, how good is the state of the art at providing a taxonomy for conduct risks at the moment? I mean, is that an area where there's a lot of progress still to be made? Raymond?
Yes, I think so. I think, taxonomy is a derivative of definition. So, if you haven't defined it well, you're not going to have a good taxonomy. But what our research revealed is that depending on organizations' current state, they start at different points. So, as we mentioned earlier, many financial institutions, particularly in Europe, started around the lending and the consumer credit processes. So around the origination, risk-based pricing, and the customer life cycle. So really looking at the customer life cycle as a process and then identifying risks and controls which are behavior related around that. So many have started that way. But then some others, definitely sort of the next sort of category of the taxonomy that we've seen activities was around financial crime. Sort of KYC, sanctions, money laundering, and there's particular focus around it, often because they've just recently been fined in that area. So,
well, we've seen a lot of very high-profile cases.
So they're being looked at
Yeah.
specifically, reputationally they're being looked at, but also in terms of audit and external audit, there are points that they need to fix. So they point the telescope of conduct into those areas. But exactly where the handoffs are from a bigger enterprise risk management and operational risk management perspective, where exactly the handoffs are between the credit, the operational, the fin crime, and so on, because most institutions, particularly tier ones, are still managing those in silos. And so forgetting conduct for a second, even the taxonomy between operational risk, credit risk, and fin crime isn't clear yet. And op risk has been around for 10 years from a Basel perspective.
Yeah.
So to throw conduct on top and expect the taxonomy is nice and clear, it's not going to happen. But yeah, I mean, we certainly have seen, we've seen certain requests for proposals out there that we've advised on at Chartis in terms of systems definitions. What brings taxonomies home usually is when people have to buy a computer system to help them, because computer is about data and data is all about categorization and taxonomy and so on. And it creates a forcing function around defining exactly what do we mean by conduct, what do we mean by operational risk, which data is mapped onto which source, and so on. So I think we're getting there. Yeah.
It's interesting when you talk. I mean, you mentioned earlier as well. If you look at the operational risks, so the capital charges, which is under the Basel Accord. If you were to look at what they put conduct risk as a separate issue and take PPI, what is it now, around 30 billion? 20 billion. I work in dollars, so I work for a US company. So 20 billion pounds in the UK, that would dwarf any of sort of the operational risk. It would skew it completely in terms of the capital charges the banks would look at. So it almost could warrant a separate sort of charge on a capital basis. Or you probably think.
No, I fully agree with you both. I mean, so in the taxonomy is a long way to go. I don't think you said it's probably getting there. I think it's got a long way to go. So yes, between the different risk types, I fully agree that well, where do you, like I said, you said it comes back to the definition. So yes, where does one risk start and the other begin, which again has its impact then on the taxonomy, saying how do you actually define one versus the other, and then going back to how. Well, if you can define, culpability or whether I intended to do harm or not, then you can't even say if this was an operational risk or it was actually intended damage. So it gets very interesting, because by the time you determine the root cause, you have to classify it up when the event happens. You don't have the time to go and figure, who did it, when, and why. So like you said, when it needs to be entered into the system, you need to define at that point, what do you think it is? So that's one part. But the other part about taxonomy is also the difference between different organizations. So even if one organization totally got it and said, here's where one risk starts and ends, here's where the other is, their understanding would be quite different to that of another organization, because having attended some of these industry events, I can see the differences. Well, some are very comfortable saying, well, conduct is a part of operations. Some are very clear on conduct is definitely not a part of operation. So we're very set in our ways of thinking, where it gets very difficult to then compare on an industry level the cost of conduct. So if you see the paper published by, I can't remember who it was, but there's a whole cost of conduct paper which has a lot of figures in it.
London School of Economics.
The London School of Economics, exactly, the LSE paper.
250 billion.
Yeah, 250 billion. I think 50 billion is set out for the next few years, and 50 billion, 200 already, spent by the top 10 banks. But again, in that, you've got included redress paid to clients, or customer complaints. Is all of that poor conduct? And then you just start wondering, where does it start and end? Because then every redress will become a conduct cost. So it's the taxonomy, as I said, has a long way to go.
And there is a colourable argument that that's correct. If you're paying redress, it's because you've done something wrong, and that's a conduct failure.
Could be. I think it's more about the standardization as opposed to. I think any way would work as long as we adopt one way, we stick to it, and we have a consistent way of doing it. It's more about figures from one place being incomparable with the others, because it's apples versus oranges. Saying I haven't included complaints and you have, and then
Yeah, exactly. Yes, there's no way to benchmark it. There's no way to get
Exactly.
But I do think they're going to have to change and go more granular on the definition of operational risk. I really do think that will be a trend in the regulators going forward. And I think I would like to see the word operational change, and I'd like to see that called operations risk. And that would then segregate it out from the conduct risk or the financial crime, because operations risk is something different. It's about contingency and keeping 24/7 and etc. That, or floods or anything like that. That should be separate to what we're talking about here. But
So
that's just
operations risk should be
Yeah.
failure to operate. if
Yeah,
you like,
yeah, to keep the
purely.
business going,
Yes,
yeah,
yes.
rather than focusing on more of these topics now, which seem to be a lot more relevant.
Not sure I agree with that one.
Yeah, I think it will all converge more than diverge at some point,
that's going
because
back.
your failure to operate, if I may, if your failure to operate may stem from me having made a bad judgment 3 years ago to have cut costs somewhere,
Exactly.
and
It's gotta be
so
an
you don't really know.
causation-based definition,
Yeah,
not
it's
a consequence and effect.
because what you're talking about is the effects,
Yeah.
but
Yeah.
conduct goes into the cause of it.
Yeah.
And by the time you determine that cause, which again may be intended or maybe oversight or just maybe lack of knowledge, could be anything, which is still poor conduct, so it's more about the cause and effect. And very often the way I would look at it is conduct risk is never really a direct risk that is genuinely a pure conduct risk. It's mostly an outcome of or causing something. So poor operations may have been driven by a poor conduct decision at the background. Technology failures could have been driven out of poor conduct somewhere in the background.
It seems
Could
like
be.
you're almost defining any bad managerial decision as a conduct risk.
Could
event.
be,
Well,
could be. I
this
mean,
is-
if you look at the definitions that come in, saying detriment for customers, poor senior manager, the entire focus on senior management having the right information, making the right decision, it goes back to that.
So I mean, if you take the pure definition of operational risk by Basel, which is a causation-based definition to do with people, process, and technology. Conduct, for me, is on the people side of the building block.
Yeah.
We're not talking about misbehavior of systems or processes. We're talking about misbehavior of people. So it's got to be a subset of the people part. Yeah. So perhaps I do think there needs more granular redefinition of operational risk. But where we ended up after doing 120 interviews and all this is that it's a subset of the people component of operational risk. And at least it brings it into an existing framework, both from a capital perspective, but also from an organizational second line of defense perspective and so on. How then it's taken out through the group organized, I think different firms will have different
I think-
approaches.
But sorry.
Sorry, go on.
No, do they get down? I agree with that. I mean, and the process side would come into that operations side. But the people side, if you take the simple definitions of what they're looking at in the capital calculations, they don't do it. They just do a multiplier times the business line profitability. So you don't get that granular level down in the capital charge.
I think you do. I think for unexpected
Not on the
costs.
simple approach. If you go down to an AMA approach, I agree on that side. And you go down a scenario or loss distribution approach, you will get that granular, you can do that, but not if you're going for a basic indicator approach on that side.
Yeah, that's just a ratio.
Yeah, it's just a simple ratio. I mean, it's irrelevant, those numbers, yeah.
Can we talk for a little about moving away from the definition side on to the next step, which is measurement, and which is KPIs, KRIs. With a topic this I don't want to say fuzzy, a topic over whose definition there's such a lot of debate. Is there? I mean, how good are companies? There's probably one for you from the survey, from the search that you did. How good are they at coming up with decent, with believable KRIs that they can use to assess conduct risk? I mean, how easy is this even conceptually?
No, I think we saw some very interesting work. Again, focusing on specific areas that they could measure. So definitely around, customer life cycle, credit lending processes, both leading and lagging indicators. So lagging being complaints data, leading being around, customer analytics, market analytics. That's been around for a long time. So we've seen some best practices around specific areas. But in terms of an overall conduct risk strategy at the organizational level, we saw less. I mean, we even seen some firms using social media analytics in terms of behavior. Both, if you think about trading behavior, there's a lot of trade surveillance, pre-trade and post-trade metrics analytics. That's financial.
So you can look for cancel corrects and things like that. Very specific.
But even in dialogue, metrics regarding dialogue, on the back of the rate fixing stuff. So we've seen some very interesting, even use of artificial intelligence. So there's a lot of sort of point solution, very innovative point solution, analytics and metrics and KRI work being done. But we haven't seen anyone really then connecting all the dots and bringing it into an overall enterprise conduct risk dashboard yet. And that really has to do with the methodological gaps that we've talked about. It's not so much to do with technology. I think the methodology is lacking in terms of how does all that customer analytics data sit with all the operational analytics data, and then all the metrics around trading behavior. How do they all then manifest and sort of aggregate up into an overall set of conduct risk measures? That piece is missing.
Yeah,
I mean,
do you think that's at the stage because I mean getting the KPIs and getting almost the KRIs as well? That's sort of the end of the process of the implementation of a conduct risk program, and they're still in that process of implementing it.
I think so. I think there's a lot of good bottom-up stuff going on, but the top-down methodological linkage, we haven't seen any good stuff.
It's interesting. I mean, I don't want to push anything up on the product, but I'll talk about something which we're doing in the research within IBM, is around cognitive analytics. And that is taking both structured and unstructured data and being able to make judgmental decisions on what the behavioural patterns is around that. We've used it a lot in healthcare. So it's not a question of the doctor just goes A, B, C, D, therefore this drug. Correct. It will take your social profile and say, well, your family's in India, we have the cases of treating this particular drug in this particular area of India. We have success around cancer treatments based on this age group and whatever. And we're looking to apply that within this framework of cognitive analytics for conduct risk as well, because you can bring it all together and it can make judgmental decisions. So
I think I fully agree. I mean, there's all of that, which is about the structured, the unstructured, getting really savvy with big data and saying, well, here's everything that I have, whether I'm listening to text or, recording conversations, picking up keywords. Using customer patterns, where clients are moving about, what they're doing, just also getting that client insight to then address things like suitability even. Those things are definitely high on general agenda, trying to see how that can be leveraged. So one of the seminars kind of was speaking at it was, using big data to get conduct right, and those are some really good, there's some really powerful examples there. The other thing with the KRIs, I think the big one is about the whole proactive, looking or, getting your horizon scan right, because a lot of the social media stuff or whether it's complaint stuff is stuff that's already out there. So clients are already telling you or customers are already telling you, I don't like that, or, and the big thing is what metrics can you get in place today which will help you detect the PPIs of tomorrow. So it's also about saying, well, which customers have taken what products, and they're not actually putting that to use, or they just take something which is probably intended for a longer term, but then they're out of it in 3 months. So what is it that you're doing to understand how well they use it? So if I take my gym membership, for example, if I was to go to David Lloyd, I don't go for 3 months. I get vouchers into my door saying, why have you not come in? So what tells you that the customer is actually not deriving value from what they're getting. And now suddenly it happens to be the responsibility of the institution to make sure that the product was actually suitable.
But you also have, I presume, an issue if you oversell a product, then you have to look at whether that was A, mispriced, or B, was it taken to market correctly? Did they understand it on that side as well? So even if that gets back to some of the return or the risk-adjusted pricing, that is still an issue as well, if it's successful.
I think, the number in itself tells you nothing.
No,
so the
absolutely.
number itself is just an indicator that there's something here to investigate. So you have more whistleblowing events or less whistleblowing events. Both could be a problem. If I have very little, could be people are just not telling you. People are just not comfortable coming out in the open. So the metric has to then just be a sign to tell you that you got a problem here. Have a look.
Yeah, it's the dashboard problem that you were talking about. You've got all these metrics, but it strikes me from what you're saying that the decision of which ones to look at and what weight to give them is still.
Exactly. I think there's a lot of risk indicators, but not necessarily key risk indicators. What makes an indicator key is not quite clear yet in terms of proactive and predictive analytics. It's around conduct risk. There's a lot of predictive analytics around credit risk and market risk as well. But around conduct risk, I think that's an area for further research. But what's very interesting for me, as I'm listening to Vinita and Neil, the sort of systems and data that they're talking about are not risk systems. These are customer management systems, they're operational systems, trading systems, and this is probably one of the biggest findings of the research we did, is that it requires almost a rethink of the architecture, the data architecture of the firm.
Agreed.
Because conduct is embedded in everything. Yep. And to really get a handle on it, you need to have a handle on enterprise data.
Agreed.
So some of the sort of turf war that there is in organizational politics around this is my system, this is your data, and so on, that is one of the biggest practical obstacles.
Agreed.
Just can't get the transparency that you
And also in the research, there's an interesting point about the fact that it's a whole paradigm shift, because it's not about the impact that that the external environment can cause to me as an institution. So therefore, I look at my little data saying, how is that little bucket is going to get impacted by the external? But it's about what I can cause to the external world. So therefore, I need to understand my entire organization, and I can't say, I'm just purely looking at this from one particular standpoint.
Sorry to interrupt. This is a very important point that came out of the report, in that risk departments, the chief risk officers, and the risk functions have all been built and set up, and their training is all around protecting the firm, defending the firm. Here, we're asking them to defend your customer, protect your customer, and it's a different mindset and a different methodology required for doing that, and you can't just do it like that. Yeah.
And it's years of training to be undone. Yeah. Because it's about people ultimately. You can rewrite a book, you can rewrite the code, but how do you rewrite your mind? That's what it all comes down to.
But years of acculturation as well. Yes.
But you do need that enterprise data and expanding it out into the other areas of risk. What we are seeing now, and that we see a lot of customers around the world, is we are seeing a very aggressive approach to transform their risk department with their data, and it's all starting from the data. And if you think about it related to conduct risk, if you've got a market risk system, well, if you've got a trader who's continually over his limits, that might indicate something. Well, you want to then maybe look at your HR system to see if there's anything which is being related to that particular trader, and then maybe link it into his credit profile, or maybe go externally and get information. That gives you a much bigger profile. But I can tell you now, from our experience, getting back to the dashboards, banks think an integrated, or financial institutions, think that an integrated or ERM platform is a dashboard. It's not, it's the data. If you've got a dashboard at the top on siloed systems, that is not an ERM approach.
Agree.
It's got to come, and it's now they're starting to realise that it's the data which is key, and that's where you start your programme.
And it's interesting you bring up HR there, because this is another, I've been talking to some op risk managers who brought up the fact that HR should be absolutely key to conduct risk, because it's about people. It's a subset of people risk. And while a lot of HR departments are excellent at the kind of the execution aspect of things, you know, processing pay, dealing with pensions, dealing with promotions, they should be fulfilling their risk management role in essentially duty of care. If are your traders having problems? Are your traders having personal problems, financial problems, whatever it is? The first time you hear about that should not be when they're being arrested or when you notice that they've been breaking their risk limits or something. The first time you hear about that should be from the HR side to say, you know, this guy's under a lot of stress. You might, you know, something we need to take issue because he's, you know, we're seeing vulnerability here. We're seeing a higher level of, you know, the risk that he will make a mistake, that he will break his risk limits, he will push the envelope because of these risk factors that we're identifying.
Well, but
I think that's a massive difference from the way that a lot of HR departments operate now.
So there is a very diligent KYC program, Know Your Customer. Is there a diligent KYE, Know Your Employee?
Exactly.
I imagine some institute, but then you get into data privacy. Can you pry on their personal life? I don't know. But if they sign up for it, but that would be, is there a continuous cycle on looking at, you do the onboarding for the employee, but do you do a regular 2 or 3 year check on that employee?
I mean,
no, absolutely not.
In safety critical jobs, you'll find in medicine, in the military, you'll find they feel,
And the police,
and the police,
absolutely, yeah.
You know, it is our responsibility to make sure you're generally okay. They don't have the attitude that a lot of private sector organisations have, where, yep, you're an economic unit, you come in the door, and when you're in the door, what you do, we worry about, and then you walk out the door and you go home, and
Nothing
that's
can go
really none
wrong
of our
between the
business.
time you come back tomorrow morning.
yeah. See you tomorrow.
That's getting back to your point on other industries. I think the financial services can learn a lot from those other industries, what you just said, in terms of their behavioural practices.
Absolutely. I mean, the rogue trading cases especially, you're looking at and you're seeing, just from the descriptions of the way these guys were operating, the way they were behaving, the way they were interacting with their colleagues, you're thinking this should have been raising red flags. You know, these guys were obviously under a huge amount of stress. They're obviously starting to behave, you know, atypically. Why weren't people picking it up? And the answer is they didn't think it was any of their business.
This is interesting. The red flag piece, and people should have been aware of it, is, so again, as part of the research, we looked at some of the cases where the loss has happened, some of the high profile cases, but when you reverse engineer, trying to see where the potential indicators could have been and where could have this been picked up earlier in the chain of events before it became a multi-billion-dollar issues. The general conclusion we've arrived is that there's plenty of red flags and plenty of clues, and management have consciously ignored them.
But the question that arises...
So that goes back to Barings, Leeson.
Absolutely.
The number of audit reports and internal memos several years before the final loss is incredible. Same with Enron. Same with SocGen. So,
the question you have to ask, though, is what's the background level? I mean, it reminds me when the Challenger inquiry, the shuttle disaster inquiry, they looked not only at the system they thought had gone wrong, but they picked 2 other systems at random and said, well, let's see, was it just the people working in this system were bad managers, or was bad management widespread? Let's have a look at this completely innocent system. It didn't go wrong at all. See how many red flags it was raising and see how they were dealt with. And they found that the problems were... So, I mean, I'm sure that you're right that, Leeson, for example, that if you look at a rogue trading case, you'll see he's raised lots of red flags. But what would happen if you looked at 5 of his colleagues who hadn't lost the bank hundreds of millions of dollars? Well, how many red flags are they raising?
None of his colleagues were making as much money.
I think that's where it goes back to indicators. You've got to see the indicator saying, is there an outlier there? And then analyze the outlier, not just purely from a suspicious viewpoint, not just already deciding that there must be a problem there, but you've got to then go in very innocently and figure what's actually going on.
Yeah. We have a culture within IBM that the manager is really culpable. So if the manager signs it off, he is taking responsibility. So in the case, and I forget the poor guy's name who's just gone to jail for 14 years. His manager in our culture would have been taking more responsibility than he did. He's a naughty boy at the bottom of the chain, but someone, as you say, is signing that off up there.
But that's a good example of probably a cultural difference between IBM and a lot of trading organisations, is that certainly in terms of who do you respect, who do you try to emulate? It's not your MD. It might be the other more successful traders. So you've got the unofficial hierarchy there, which doesn't really map onto the official one. I'd like to talk a bit about the other side. So we've talked quite a lot about the censor side of the loop, and I'd like to talk about the effector side, about incentives, about what tools risk managers in general have to actually address these conduct issues. A lot of the focus has been clearly on financial incentives. We've been talking about the mis-selling cases. Obviously, a lot of those were linked, as I said, to bonuses linked to short-term sales targets. That's the main one that the regulators have focused on. Is that the right one to be focusing on? And what other tools are there in the box to affect people's conduct?
I think in terms of incentives, I mean, also looking at the papers again, interestingly, organizations are focusing less on incentives, so it tends to be one of their lesser challenges that they acknowledge, and I think they do need to acknowledge it a bit more. So yes, incentives have a big role to play, because you can have all the right training, all the right cultural messages, the right values around the organization. But if you're being incentivized poorly, someone's going to slip at some point when, like you said, or if individuals are under pressure, they're going to succumb to potentially, incentivization like that. So one of the examples that I think the previous your home serve, there was the example of, the culture and people being incentivized. And there are many, many examples of that. But another part that we're missing in incentives, and again, it's in the study, interestingly, is about disincentivization of poor behaviors. So, there can be, saying, well, yes, I'm not incentivized to do something bad, but if I'm going to go ahead anyways, what is going to be setting an example for the others to say, well, you can't get away with this, it's not okay. So that probably sometimes I think leadership then has to come in again and to really call out what is not acceptable, because sometimes we focus too much on good behaviors, but if we are turning a blind eye to bad behavior, that in itself is also sending a very powerful message. So with incentives, it works both ways.
Yeah, absolutely. Absolutely. And certainly with disincentives, it's not just a case of, if you like, the size of the disincentive. It's also a question, psychologically, it's also a question of, well, how quickly will this be noticed, and how likely is it to be noticed? Because, if you can say to someone, if you do this, you will lose your job. But if they know perfectly well that you're only going to pick it up one time in 1,000, and then it's going to take 3 years to do the investigation, that's a negligible disincentive. That's not going to affect people's behavior measurably at all. So but it's a good point, but it has, the conversation I think has to be around more than just the size of the punishment, if you like, the size of the penalty.
Agreed.
I agree, but I think that the non-linear growth in the size of the penalties is working, actually.
I agree.
Where we're seeing the same sort of KYC failure or AML failure, where 5 years ago it would have been a $100,000 fine, which the bank would say, this is just cost of doing business, no problem, carry on. Now it's $1 billion, $5 billion, $10 billion. Then, and we're seeing tier 1 international institutions saying over a 5-year period, 20% of their net profit is for paying fines. We're now seeing huge investments in risk management, and compliance. And I don't think it's just about throwing money at it, but I think the fines are working. That shouldn't be the only, the stick should not be the only way to do it. We need some carrots and sticks, but bottom line is it's financial services, so finance, is what these guys are there to do, and to make a profit. And if the fines are taking significant profit out of the pocket of the firm and thereby of the traders, we've talked to heads of front office traders who are now saying, through credit value adjustments or new liquidity ratios, a significant part of their personal P&L is being put aside for capital adequacy. It's hitting them in the pocket, and they're changing their behaviors. So I think it is working, but I think there's a package of things that need to happen, not just one thing.
I think it's working. I would agree. The only thing I would say is that's not the way it should work, because it's temporary change in behavior potentially. So are you going to then continue that fine culture? It's about saying, well, what is it that's going to, if it's hitting the pocket, I'm changing my behavior. Is that how I plan to make it work forever? Or is there something that should then create that paradigm shift so that I continue to demonstrate that behavior even after the fines are gone or reduced?
But what's interesting, a lot of the risk takers are exiting. They're leaving. They're going to hedge funds or shadow banking and so on. So it's resulting in some level of cleansing of the type of people as well. So, well, yeah, these are all.
I think there'll be the dynamics to watch, as the behaviors come out. With HSBC probably saying, well, they're going to shift their headquarters, then there'll be probably a rethink on, well, is this fine, perfectly fine? The National Australian Group, pulled out of Clydesdale. So there's going to be a rethinking at both ends, saying, well, how much do we want to fine, and, what are the benefits versus the costs?
But I think one of the biggest changes we've seen over the last 6 months is that it's now, we're seeing that it affects the CEO. So it's hitting the C level. And the minute it hits the C level, then they will be completely aware. And they should then view that as a cultural change within the organisation. And I think we've seen the regulations coming out that the non-executive directors now on boards could face jail if they've ignored certain...
7 years.
7 years in jail. And we had two HSBC Neds who said, I'm not accepting that, and resigned. Yeah. So we are seeing that at the top. So we've got a top level awareness. If we get the bottom level, I think then we're making significant progress. I think we are there. But it's interesting on the incentives. So do you think it's the incentive in terms of the commission, the bonuses, or do you think it's another aspect in terms of fear of losing your job, or in terms of...
Oh, I don't know. I'm always of the view that non-financial incentives matter a lot more to determine people's behaviour than maybe we'd like to think. I think people aren't I think people are far less economically rational than maybe we'd like to believe. I think it's shame and guilt and pride and acceptance by the group that really
I agree. Absolutely,
define what we do. And what's interesting, we've been talking to people in other industries and in the financial sector in other countries as well about the sort of the codes of conduct. And there are countries where they are now, or they're considering having a kind of Hippocratic oath for bankers. You sign up. You would go through this as in a ceremony as to mark your qualification, and it would include these are the things we don't do. And it's not we don't do them because we will lose money doing them, or it will endanger a bonus. It's simply we don't do this because that's not the kind of people we are. This is it's a way of changing the self-image, if you like, collective self-image of the industry. So this is just unthinkable to us. I define myself, we all define ourselves very largely by our jobs, and part of my self-definition as part of my job is that I'm not the sort of person who does this.
I think it's quite interesting that you say that, because there's a book, it's called The Honest Truth About Dishonesty, Danny Ariely. So one of the examples that he does say, what makes a person actually, go out and cheat in some sense. And one of the experiments he did have was, when you're filling out an insurance and you put out your mileage out there, if you did ask people to then sign saying that they're being honest about it, there's a higher likelihood that they will do it honestly. So again, it's about when you really just remind people of the codes of conduct, then they're more likely to behave more ethically.
Yeah, absolutely. I mean, and it's also a case of the institutional memory, I suppose, as well. It's if you have, and hopefully this is what these regulatory actions are trying to build up. It's a sort of library of incidents. Oh Lord, we don't want to do something like that because we all remember what happened at 5 years ago at this bank, or last year at another bank when that happened. Yeah. So a case of building that in as part of the story that people tell themselves.
It's interesting. We go through graduate recruitment, and we select. We look because we're quite analytical in what we do. We look for sort of mathematicians and physicists, and we select them. And I've had feedback, quite a few graduates saying, I don't want to be associated with banking and financial services because of the perception that the youngsters have got from what they've seen. So I think it is down to that as well. So another point as well, it's if you look at it, it's across our sort of our culture and our life. If you look at the Premier League football teams and what goes on there, and it's all like cheating, and we've got it from the weekend as well with how Chelsea behaved and all this.
Got it at FIFA.
Yeah, and FIFA. It's not just so. These our children are being brought up to say, it's all right. You pretend you've been hit, or pretend you get a penalty and all that sort of stuff. So, I think one of the best industries sport they talked about was golf. Golf is one of the most amazing. If someone says they're a golfer, and I know you're going to get dishonest golfers or whatever, but the professional golfers, they will actually admit, and they will say, because they're being scrutinised on the TV, but they are very well behaved, the professional golfers.
Yeah, it's and
Because
part
in
of it,
golf, I
yeah.
think I'll just add to that point, because in golf you're usually competing with yourself.
Self. There you go. Yeah.
That's the fundamental difference. You're trying to up your own game.
So you think the
trying
football?
to
Yeah.
fool somebody else. you know,
So,
yes.
so just to provide an alternative view here,
Please do.
is because we're all agreeing with each other. So, I do think there's a fundamental difference, though, between the trading book and the banking book, right? So, and those that are working on the trading side of capital markets, their job is to trade risk. Their job is to take risk and make money out of it. And part of that risk taking is game theory against regulatory arbitrage around rules. That's how you get your edge. So, whereas you don't trade. Okay, maybe you're doing energy trading and commodity trading, but you can argue that's financial services as well. The other industries, generally, you're looking at downside risk, whereas these guys are paid and they're recruited specifically to create upside risk. And that does create, that is a different, to compare that to a golfer or to a guy working in a IT company, it's, I think, a little bit naive. Because a trader is recruited to come and take some risks to make us some serious money. And that's
It's
what
the job.
you've been recruited
Yeah.
for.
Yeah.
He's going to try and play as close to the lines of the rules
Great.
as possible. And every now and then, he will pass the lines, the grey line. If the lines are grey and not well defined, and the risk appetite of the firm is not clear, they will apply their own appetite, risk appetite, which might be misaligned to the firm's appetite. So I think there's some good stuff around the rest of the world, but if you're a trader sitting on a trading floor and you come in the morning and you're told, take some risks because we're interested to make some serious money here, then
And that's the spec, and that's
That's
the
the- that's the
appetite.
spec.
Yeah.
That's
Do you
Because-
still think that? I mean, 5 years ago, yes, but now the constraints on the traders with what you talked about, the CVA, the XVA, liquidity, clearing through this particular exchange, that is being squeezed.
it's being squeezed, and they're leaving,
Yeah, that's why. Yeah.
joining 2-3-man hedge funds in the shadow industry and making a lot of money there.
Yeah.
And it's unregulated.
Yeah.
So that's what I'm saying. So so then what that means, the old profits will be diluted. You look at the average return on equity for a bank. It's gone from double digit to low single digit now, right? So sure, it's less risky environment, but they're making a lot less money.
Sure.
So you've got to get that balance right. So the ROEs are 3, 4, 5%. You look at Morgan Stanley.
Which is below the cost of equity.
It's below the cost of equity.
Before
So
the
the
crisis-
industry is changing.
Before the crisis, they were getting banks. The average was about 18%.
Yeah.
And as you
When
say,
you-
it's nowhere near now.
So I think there's a balancing act. You could take it to a far. We would be the most ethical, most lovely, fair organization in the world. But you know what? We make no money. Basically, we become a loss-making organization. So you need to get
I
that
think it's about
balance
finding
right.
the balance. I would fully
Yeah,
agree.
right.
Because
Conversely, I mean, you make the point about these two very different cultures, and what you absolutely can't have is the trading book culture infecting the banking book. Which is
Exactly.
you don't want your retail bankers looking at the guys on the floor above them making huge bonuses in trading, thinking, I want to be like them. I want
Exactly.
to act like
I
they
agree.
act.
I agree. That's why we are seeing. I think the shift that we're seeing generally is retail consumer banking is becoming more of a utility industry. It's for the good of the economy. Those who want to play in the casino, here it is.
and that
raise some
variation
funds and
actually
play
is
in the
more
casino.
dangerous than beneficial. And it's about finding that balance where you can look at the other and still feel you're in a fine space.
But even on that, I mean, 10 years now clawback on bonuses. I mean, I'd struggle to see why anyone would want to go into the trading investment bank area. Because even if you get a large bonus and you go off and buy a house, you've got something could happen in 9 years where they come and take the money back off you.
Yeah.
That is a very
It's
big
a-
disincentive,
yeah.
yeah.
I think it's going to be very interesting to watch the next
Very
10
sleepless
years
9
to see
years.
how that actually
But
affects
there's no point in
behaviour over the long
no
term.
point in stamping out that problem in the corner of the carpet and it appearing elsewhere if they're all going to the unregulated hedge fund industry, because we know where the next problem will occur in there.
That's another very good point. And this is conduct risk can't be just a focus for the banking sector at all. It has to be a focus for the whole of the financial. It's as we've seen, as heaven knows, we've seen enough over the last 10 years. It's a highly interconnected business, and the problems, the next crisis, the next set of problems could really start from anywhere. So conduct risk has to be a concern for every part of the industry, no matter how remote from the retail consumers, it seems to be. It's probably a good note to finish on. Thank you all very much for coming along. Thanks for a very
interesting.
lively discussion.
Yeah.
Yeah.
Thank you all for watching this webcast from Incisive Media today. My name's Alexander Campbell. I'm the editor of Operational Risk, and I was joined in the studio today by Payman Mesjan, Managing Partner at Chartis Research, Neil Dodgson, who's the Global Head of Customer Solutions Group at IBM Risk Analytics, and Vinita Ramtree, Head of Conduct Risk at Barclays Wealth and Investment Management. Thank you for your time.